did Trendstat and grew that to 600 million. And so my life all of a sudden became the life of a money manager as opposed to a chemical engineer. I think that way you'd get the maximum amount of diversification for the minimum amount of money and control it with your position sizing on the risk side. That'd probably be the advice to new traders. The compounding thing came in probably about, I don't know, 6 to 8 years out of university, out of college, when I started realizing I could just kind of keep grinding this and it would end up being a lot of money. What I call true diversification. And true diversification to me is taking any one thing that you trade and asking yourself the very worthwhile question of, does the item A have anything to do with item B?
In this episode, we had the pleasure of talking to Thomas Basso, a legendary trend-following trader. He is best known for his appearance in Jack Schwager's The New Market Wizards, and Tom's insights have influenced generations of traders with his calm, methodical approach to the markets. Tom ran Trendstat Capital Management, a successful money management firm with over 600 million US dollar under management, and he has decades of experience navigating the markets. In these conversations, we dive deep into topics like emotional stability in trading, building systems that suit your personality, long-term consistency, and the importance of developing a relaxed, enjoyable trading process. This episode is filled with timeless trading principles from one of the calmest minds in the business. Enjoy the episode. So, hello, Tom, and welcome, and thank you so much for taking the time to talk to us today. I'm really, really excited.
My pleasure.
So I've been listening to a lot of your podcasts recently. I've read The Market Wizards, obviously, a while back. And what really stood out to me is that you keep repeating that your system has like a 30% hit rate. And what I see from our data on the users is that one of the biggest issues that have is holding on to their winning trades. So with a 30% win rate system, I would assume your winning trades must be much larger than your average losing trade. Was this ever an issue for you holding on to your winners?
It never was, because I think I came to trend following before I knew there was a word trend following. I didn't have a clue. I just sat there and I looked at a bunch of charts and I said, if I could pick up that corn trade over here or that German mark trade back in the old days, I go back that far for the euro. You could have made just so much money on that one trade that you could lose on a whole bunch of others and you'd still be ahead of the game. So my mentality was always I have to pick up that big trade, the next one, whatever it is. I have no idea what's coming next. Maybe it's silver, maybe it's hogs, maybe it's the euro or gold, or you just don't know. I don't predict. So I'm sitting there just trying to sort of place bets, if you want to think of it that way, across 30 something markets in both directions with multiple strategies and multiple time periods, in the hopes that one of them has the good sense to start running and go crazy. And that's where I make all my money. And the rest of the time, I sort of do a lot of work for nothing.
Yeah. Did you start off like this as well in the beginning? Because we see it, especially newer traders, as soon as the trade hits a little bit of profit, they're out, and that's damaging the performance quite a bit.
Yeah, maybe in the first, 10 trades that I did in my life or something like that. But pretty quickly, I was trying to adjust myself to what would work. And I knew that I was not having a very good hit rate. And I knew that I was cutting my losses short, and I had no clue what I was doing. And there was no internet back then in terms of mentors or podcasts that you could watch or interviews you could watch. So the engineer in me just said, sit down, get a calculator out, and pieces of paper and graph paper, and start burning my eyes out. And I did that for a lot of weekends and evenings. I just sit there and study things and crank numbers as best I could. And I used Wall Street journals for my data. I had no ability to download data like we do today. Things that would take me today, maybe an hour or less, would take me a week or more. So it was
Oh.
just hard to imagine. So you had to have a vision of where you were going, set a project, set its criteria, crank it, and then figure it out. And so I would say that once I got trading, I quickly, through journals and through just trying to keep track of what I was doing that didn't seem to work and trying to figure out what might work and studying just a bunch of graphs laid out on the floor. And I'm sitting on the sofa and I look down and I can see that may move over there and this move down and that move up. And man, there's some really big moves. If I could just get those, the rest would take care of itself. So it kind of cemented the mentality of staying in a trade that was winning. So my win rates and some of the strategies at Trendstat when we used to measure it got up in the 3 to 4 to 1 range. And there was one strategy we did that we called max trend that got up over 7 to 1. Its hit rate was more down around 25%. So it was even harder to create a profit. But when we did, boy, we cleaned up. So that's kind of what we went for in the Trendstat days. And since I've retired about 20 years ago, I would say I've expanded a little bit into more multi-strategy. And I think Lawrence Bensdorf, who would be a great interview for your guys if you ever have a chance to interview him. He just came out with a new book, actually. I just received it yesterday, Trading
Nice.
Retirement Accounts. It he speaks 6 languages. He's a Dutch guy that is now living in Brazil. He's been all over the world. He speaks a bunch of languages, and I've done some seminars with him, and he's affected my thinking quite a bit and simplified my thinking, I think, even more importantly, about multiple strategy trading, and that there's a place in the world for trying to increase your return to risk ratios by not necessarily just increasing your returns, but decreasing your risk. And by having multiple strategies that are clearly defined as sort of fighting each other in ways, like, for example, simple example, very long-term trend following model. You get 200-day moving average or something really stupidly long. And then you put in maybe a 3-day Donchian channel on the same market. What's going to happen is you're going to have a long run. You're in on the market. You're making a lot of money. Boom, boom. The distance to your stop on that long-term strategy is going to create a lot of risk per contract in that position. So eventually, sooner or later, if you live long enough, the market's going to turn and it's going to go all the way back down to that stop. And you're going to take that amount of a loss. And that's going to be the start of your drawdown on that particular strategy. Now, take another strategy that's a 3-day Donchian. In 3 days, 4 days, 5 days, it's going to trigger a down signal. You're going to have one short, one long. You're going to be sort of out of the market. So you're not suffering that drawdown anymore. And it could go through a transition. It could turn around and take off upside again. Or it could crash and go back to the stop. And any way that it wants to play itself out, at this point, you're not in the market because you've got one long, one short, you're neutral. So you've just kind of diminished the amount of risk of drawdown in your portfolio, and that reduces your denominator of the return to risk ratio. And sometimes you can have a lot more effect by reducing the denominator than you do trying to increase the numerator. So I have found that keeps me a lot more balanced, much more serene for Mr. Serenity. It just seems like it's an easy way to go for me in retirement, especially. And Lauren's new book is Trading Retirement Accounts, interestingly enough, is the title. But I think that's where a lot of traders, especially new traders, there seems to be an obsession with return. I want to be a billionaire by the time I'm 30 or something like that. And I think by focusing just on the return side and not the risk side, you can leave a lot on the table because if you examine it, return to risk is such that if you can increase your return to risk, you can always run your leverage higher if you're confident that the return to risk is truly really good. In the example I gave, for instance, are you really taking on that full drawdown risk of the long-term strategy if you have another strategy that's going to mitigate part of that risk? And you know it because that's the way the math works. You've not only simulated it in history, but you see it in real life. You see the position on the short term go short against your long, and you see yourself taken out, and the broker prints a zero beside the ticker up there on the screen. Well, you know that you're long and short, but only you know that. The broker doesn't know that. And broker says you're out of the market. All right, well, that's affecting your equity. How? It's keeping it unchanged.
Right. So you foreshadowed like three things I have written down here that I want to talk about.
Okay.
I think let's go to the expectations. You said a lot of young traders, social media makes this, I think, even worse, focusing on making a lot of money in a short amount of time. And what we see, those unreasonably high expectations can lead to a lot of problematic behavior. And we see a lot of data that is also very qualitative. So we see exactly what traders think that they're doing. And very often, if I think, and what we have seen in the data, we could see a lot more long-term profitable traders if they would settle for much lower, more reasonable returns. What was your perspective on returns when you started out? Because I don't want to say you played it safe, but your returns over decades are astounding. But on social media, people want to make 20% in a week or in a month. I think that's very,
Yeah, they
very
might be
damaging.
astounding to a long-term observer of the last 50 years of my trading. Some people would wisely say, hey, Tom is still being interviewed at 72 years old and is still trading. And there's a whole lot of traders in some of those Market Wizard books that are either dead or they blew up or they're in real estate now or something else. And so to some extent, that, I don't know, I find that one of my achievements. I just lasted long enough to be even doing this interview. But I think what ends up happening is on a just a pure return standpoint, if you looked at some of the stories, particularly in the first couple of Market Wizard books, but I think even a couple of the others, where you get these guys doing certain strategies that you know lined up with the market. They might have been really brilliant people, but the combination of some good ideas, maybe a little luck, maybe the market's going their way, create a really, really super outsized return, which makes for good story time in a Market Wizards book. But it isn't necessarily a 50-year strategy of being able to just plod along and create compounded returns and keep growing a business and keeping your clients on the books and all the things that I had to do when I was running Trendstat. And I still have to do the last 20 years of managing my retirement money. So I think that the new traders that are trying to get the 100+ % returns that you read about in Storytime and various books, whether it's Market Wizards or anything else, they're still focusing a little bit too much on return, and they're not seeing the Achilles heel there of the potential risk that they take on by doing that. The risk of ruin, the risk of huge drawdowns, the risk of you're managing client monies, the risk that you have your clients come and go all the time. You know, you're hot today, so you bring in a bunch of money and then you have a drawdown and all the money goes out the door and then you're out there marketing again, trying to bring in more money. I tried to keep the clients a little bit more even keeled, just like I was, to try to keep the books sort of balanced, keep the business stable. And so, you know, you look at the average person out there that really has no idea, like a client, um, they're busy doing whatever it is they do to make the money that they put in the portfolio. They just want to not lose a lot. They want to make more than after your fees than they could have themselves by going and buying some completely passive tame investment like a bond or a CD or some kind of a money market fund. So your bar isn't as high as most money managers think it is. Now, in terms of competing with other money managers, the bar is higher because the guy that's got the flashy track record is going to garner some attention, and you're trying to garner some attention to get the client monies. To me, I always tried to emphasize the return to risk ratio, the steadiness. I was always kind of a boring personality. I've never considered myself a great marketing person. I am not out there. I'm more of an engineer. A good day for me is just being on the computer all day, let's say, or in these times, being outside in the yard, pruning bushes or something. It's not that flashy being me. But some traders that I've run into over my years that would lean towards the flashy side. They really want to push it, and they want everybody to trade like they do. And I don't know. Everybody's different. There's no reason why you guys should trade exactly like I trade. You don't have my knowledge. You don't have my computers. You don't have the same net worth I do. Maybe there's could be lots of different reasons. You're in different countries. You may have different legal restrictions, different tax laws that affect your decision making. So each one of us should probably come up with slightly different ways of approaching investing or trading. And so I look at it that way. And so managing risk becomes far more important. Being able to trade for 50 years and keep coming back and playing the game again tomorrow, and not running into the risk of ruin is very important. And a lot of young traders, even despite journaling, will stick their neck out a little too much, and sooner or later the market teaches them a lesson, and they go, now I gotta save some money, I gotta open another account, I gotta start all over. Did they learn any lessons from that? That's where a lot of the new traders go wrong, is they try to hit the home run right out of the gate instead of just getting comfortable with a few singles and just plodding along and making money, and realizing that compounding over their lifetime will make it worth a lot of money.
Do you think that your nickname, Mr. Serenity, comes, or your approach to trading and to life in general, comes from your ability to firstly focus on risk management versus I need to make 100% this year, plus at the same time you created your trading strategy around your lifestyle as opposed to having to conform your lifestyle to your trading strategy?
Yeah, exactly. A lot of traders will look at something. Well, a lot of traders, good example, they want to copy me. I get barraged by questions and direct messaging and comments on X and all that about how many days do you use for your Donchian channel in this particular strategy? And I just say, okay, well, it's 21 or it's 9, but it doesn't make any difference. You can make it 10, you can make it 15. It's whatever works for your situation. I designed it for me, for my situation. I'm just putting it out there as an example so that you can start with the concept and say, well, that's a little too slow for me. I don't get enough action. I want more action. So I'm not going to do a 21. I'll do a 9, or I'll do a 12, or I'll do a 15 because I want a few more trades. I want to be a little more sensitive. And realizing when you do that, you're going to get a few more whipsaws. Your your reliability will tend to climb slightly, but your return to risk, or your expectancy, will go down with that. And I can plot this stuff out. I've run studies over 50 years with computers, and there's no perfect answer. It's a little bit more what lines up to your lifestyle. And when Jack interviewed me for the New Market Wizards book, I think he sensed that not only was I concerned with return to risk, and that kept me a little bit more methodical and a little more risk averse. Maybe the returns weren't as flashy as some of the other guys he interviewed, but he also saw how I had integrated both my clientele, my own investing, and my own psychology into that return to risk world, and automated a lot of that so that it would be executed flawlessly. So I didn't have oh my God, the market's doing this today, and I go crazy and my psychology is all over the place. For me, every day was just another day at the office, running the computers, bringing in the data, processing it, shipping out orders, dealing with client calls. My life was pretty simple and maybe a little boring compared to a lot of people. And I think that that's where the Mr. Serenity name came from Jack, really. It wasn't, I didn't have anything to do with it. He asked me, are you okay with me calling you Mr. Serenity? And I said, Jack, it's your book. You can call me whatever you want. Like,
Nice.
I'm not writing the book, you are.
I'm wondering, did you have this long-term view and a focus on risk and really the belief in compound interest early on? Did you start with that, or how did you get there? Because I think
Well,
this is so
when I
important.
first started, no. First started, I was just like every small young trader, very little money in my account and just trying to make a meaningful dent into my ability to sustain myself. I was a chemical engineer back in the 70s. If you study ancient history for you guys, because you weren't alive then probably. Um, there used to be booms and busts, like every 4 years there'd be an economy would go through sort of a good period and then a recession, a good period recession. We were very cyclical. And the Dow Jones Industrial Average would bounce from 500 to 1,000, back to 500, up to 1,000. We went through 10, 12 years like that. And I knew that when we went through those recessions, chemical engineers tended to get laid off. So I thought I better save some money and better do something with it. So for me, I was trying to get enough return and enough savings from my chemical engineering salary into my investment account so that it would be meaningfully able to provide for me if I got laid off. That was the original purpose. Once I was successful, and now my assets are getting in my portfolio up over 100 grand, and we're approaching a stock portfolio of 100 grand and maybe a futures portfolio of about 130 grand. And we're starting to have enough money to think seriously about, I have no problems if I get laid off. I can last at that level for years off of my very low cost of living that I had at that point in time. And so I started then thinking through, all right, well, this is a little bit more of a long-term thing now. I can go ahead and continue to work on a career. I ended up getting an MBA along the way. I ended up taking architecture courses and designing a custom home in the woods outside of St. Louis, and did a lot of things. I have lots of interests, and I explore my interests. And so what ended up happening is that right around and then, right around the same time that I started getting asked by people, hey, you're doing pretty well with your portfolio, because I talk to people at lunch, and what are you doing? What are you doing? You exchange ideas. And pretty soon there was an investment club, and I'm essentially managing it with another guy. And the two of us kept doing that, and the investment club flourished. And then we decided, we probably could turn this into a business on a side. It doesn't take us a lot of time to do this. How about if we continue to be chemical engineers? And then on the side, at night and whatever, we'll just go ahead and make our decisions, call them into the broker. And we started doing that. And one thing led to another. And all of a sudden, we meet a third guy doing that. And we form a money management firm, and we get registered as investment advisors. And all of a sudden, we've got 7 million under management, and I'm able to leave my chemical engineering job with the same exact salary that I was making as a chemical engineer, with zero risk. I had the same benefits, same salary. I opened the office, hired the secretary, programmed the computers, brought the other two guys out of full-time onto full-time money management. We grew that firm to, I don't know, about 70 million. And then I peeled myself out of there, did Trendstat, and grew that to 600 million. And so my life all of a sudden became the life of a money manager as opposed to a chemical engineer. I had no clue when I graduated college as a chemical engineer that this life that I've lived would have been what happened. This has been sort of just trying to keep up. I'm just watching my life unfold and watching the movie of my life unfold. It's been a good life. I have been challenged mentally and physically, and I I've dealt with those things, and it's been fun. But I think when I started out, I think there was this return potential, but the compounding thing came in probably about, I don't know, 6 to 8 years out of university, out of college, when I started realizing I could just kind of keep grinding this and it would end up being a lot of money. And along that same time, doing the money management thing.
Yeah, yeah, that's impressive. And with this 30% win rate, just when you run the data, you must hit drawdowns frequently, just based on the statistics.
Frequently, you're always in a drawdown almost.
Yeah.
You hardly are ever making new highs if you mathematically figure it out.
All right. Did you have problems with those long losing streaks, and how did you get out of there, especially when the money grew substantially?
You just need to ask yourself, have you seen any market that you trade that has made one of those outsized moves? And if the answer is yes, and you missed it, then you need to critically find out how you missed it, why, and how you'll put things in place that you will never miss it again. And you've improved your trading strategy by doing that. If you did miss it and it was, or on the other side of it, you didn't miss anything. In other words, the last 6 months you've been in a drawdown, there hasn't been a single market that's made a major move. Well, then there wasn't one of those major moves to catch. You would expect to be on a drawdown. It is not broken. Don't try to fix it. Just keep doing what you're doing. Wait for that next big move to happen. And it'll happen when it happens. You'll have no control over it.
You talked about the book, and I heard you talked about also this pothole strategy. And I want to ask you about when you're having multiple strategies. We see it a lot of in traders that have many strategies at the same time. It can be confusing. It can create a lot of noise for traders. How do you best go about adding new strategy to your approach?
The first thing I like to do is I like to look at where my existing portfolio of strategies is likely to mathematically have a weak period. So you critically, in the book I called it, and Lawrence Bensdorf, who I mentioned earlier with this book, called it filling the pothole. You got a track record that's going up the page, and you got a drawdown, and then it makes new highs. Well, that drawdown is essentially sort of like a pothole on the way up the hill. And wouldn't it be nice if you could just keep the line straight going up the hill? And so what I do is I try to analyze what in my strategies is the weak math, what kind of market action creates the drawdown. So you try to understand the drawdown by honing in on that pothole, and get your worst pothole is the best place to start, and try to understand what happened. Was it just one strategy and one market that created that whole thing? And is that something that is likely to happen again? Or is it something that's applicable just to that one market? Maybe you don't trade that market anymore or something. I don't know. There could be a lot of things, but you can analyze it at least and try to figure it out. And then you can say to yourself, well, given that kind of market action and the things that I trade, what sort of strategy would tend to make money during that type of period? And once you try to say that, you then start seeing some math in your head of, okay, well, I've got to exploit this kind of market action. And for that, I need a long term, or I need a short term, or I need a overbought, oversold indicator, or I need some way of measuring this condition and knowing that I need to trade this way. And you go ahead and you run a simulation on it and you say, okay, well, that's doing really great right during that one period where the pothole occurred. I wonder how it does during all the rest of the period where I've got all these other indicators that are already making money. And in this particular math may lose money, and I've got to make sure I balance it properly. so that I don't cost myself too much on the other periods to help myself during the pothole. And then you run the simulation, you figure out how to sort of balance the allocation to the different strategies in your portfolio, how leveraged you're going to be in any one type of strategy. And then you've hopefully are comfortable with the math. You understand what you're getting into. You know with each strategy where it will tend to make money, where it will tend to lose money, and where it will just do nothing and hold its own. And like up, down, sideways, volatile, non-volatile, there's lots of different conditions the markets will take you through over your lifetime, 50 years. You're going to see a lot of different things. And you have to understand with every strategy that you employ, where do you expect to make money? Where do you expect to struggle and have a drawdown? And that prepositions your brain and your emotions and everything else for if you're in a drawdown and you look at the markets and you say, well, yeah, you should be in a drawdown, you know, cocoa's going sideways for the last 2 weeks or whatever. You know, that type of thing, it gives you the psychological comfort level to say, you know, it's not broken, just keep doing it. Just keep it on.
I'm curious, did you catch the cocoa move last year or 2 years ago?
Mm-hmm.
Nice.
And orange juice the same year or the year after, I can't remember. Those were
massive
big
moves.
Those were big profits. I mean,
Nice.
we're average, you know, an average position on unrealized percentages might be, you know, you might be up 5, 10, 15% on a market. Those would be 100%. You know,
Yeah.
those are massive wins.
Yeah. I think 2024 cocoa even outpaced Bitcoin.
Yeah, exactly. And I trade Bitcoin futures. So there's times where, you know, lately, the last few weeks, the coins haven't really done all that much. They kind of drifted a little higher. I think last I looked today, they were doing okay, but you know, it's not been a blockbuster like it was a few years ago.
Yeah.
But you know, if this thing falls apart and hits my stops, I'll go short and I'll ride those markets down. I don't really care. I have no bias as to whether Bitcoin should be at 500,000 or at 50,000. Whatever way it goes, I go. And if you do that across enough places, enough markets, you just sort of you realize that you really don't have any opinion about anything because it's hard to focus on 30, 40 different things in your brain. It overwhelms your brain. So you kind of give up and you delegate it to the computers. And your job as a creative trader is to keep analyzing the data, keep creating new software. I'm still working on more software to trade, things to ways of measuring return to risk. I created in my research papers on enjoytheride.world website, you'll see something called the ETR, which stands for Enjoy the Ride. It's on my shirt. ETR comfort ratio. And all it is a collection of all the up days that you're making new equity highs or above your threshold of pain, which for most people might be 5 or 10% down. Anything above that that's a positive day, you keep accumulating those returns and those days. And you add them all up, and then you take your threshold of the downside, let's say it's 5%. Anything that's 5% or worse, you are in a discomfort phase of your trading. So you start adding up all those days of how much are you down and how many days are you in it. And when you add all of the discomfort and you add up all the comfort and you put the comfort over the discomfort, you have a comfort ratio. And that is closer to the way most traders would actually look at return to risk. And in fact, clients as well. Their threshold levels may be different, but the concept would be the same. So I use that when I'm getting done with a historical simulation. I'm trying to compare two runs. I'll run a comfort ratio on both of those and try to understand which one would have the easier and more psychologically pleasing way of getting to the returns, because the returns are fine. But, if, for instance, if one strategy has a 15.7 and the other one has a 15.8% return, they're essentially the same. But if one has a comfort ratio that's exceedingly higher than the other one, I'd rather do the comfort ratio that was higher. So that's the way I look at it.
Okay, interesting concept. I never thought about it that way.
I
I
just
have a
looked at
question.
what do I really believe? And
Yeah.
I looked at it, started out with, I was doing an article, I guess for Substack or something, and it was on various return to risk ratios. And I realized doing the write-up how many academics, like the Sharpe ratio and the Sortinos and some of these ratios, I look at them and I said, that's not the way most traders think about return to risk. How
Yeah.
did these guys win a Nobel Prize off this stuff? This is crazy. So I kind of got done writing the piece, and I don't know, I was sitting there with a spreadsheet and a bunch of S&P data that I had pulled down. It was like 35, 40 years of S&P data that I've had for years. And I just started puzzling over, well, what math would I create to really measure return to risk? How do I do that? And I just created it out of just understanding this is when I'm happy or comfortable, and this is when I'm uncomfortable. So it became a comfort ratio.
That's
Well, you
great.
can get the math and everything over on enjoytheride.world.
Yeah, we
Yeah,
put everything in the underneath the video so people can check it out. Highly recommended.
Mm-hmm.
I love when I heard you talk about the role of trading in your life and how you see trading fit into your life. You said you don't see, or you don't even want to see yourself as a trader, but trading is just something that you do besides all the other hobbies and interests that you have. I was wondering every time, is this something you had from the beginning, or did this evolve over time?
Yeah, well, in the beginning, there was only so many hours in a day between having to eat every now and again and sleep for 8 hours or so, if I could get that much. There was only so many hours. I was doing a million different things, and I was doing things in my 20s that I don't think I could do today at my age. But um, I think what you end up with is sort of this concept of, I always like to go out and play golf. I always love to go out in the yard and prune bushes and, add some flowers here and there, or, cut off the limb on that tree that's in the way and make everything look beautiful out there, and be outside in the sun and get my vitamin D. And I guess I've always had that tendency to think of myself as a guy who has a lot of different interests, one of which is trading. I think the outside world tends to look at me as a trader. It's unavoidable. I'm Mr. Serenity and I'm a market wizard and blah, blah, blah. And I did Trendstat Capital. And so I get that label a lot. And certainly that's the reason why I have 57,000 followers on X. But if you look at my entire week, like tonight, for instance, I sing in a church choir. So we have choir practice tonight. So for what, 2 hours or so tonight, I'll be practicing the next couple Sundays worth of tunes that we're going to sing and making sure we've got it tight. And I'm part of a 40-person choir roughly, and part of a pretty good bass section. A lot of guys that have really good voices. They can read music. They can hit the notes. I have to focus. And so at my age, focusing, if you think of music and having to use your eyes to see the music, goes into your brain says that's a low C. It instructs your vocal cord to try to hit something pretty close to low C. You're hearing the tunes in the background. This is all blended in so that you're adjusting your voice for that low C. You emit a sound from your voice. you immediately hear it in your ear internally through your ear system. You say, "Ooh, I'm a little low." It immediately adjusts your voice to the right note. Now you're perfect, but at the same time, you're reading the next note and the process starts all over again. So by the time you get done with 2 hours of just practice of singing, reading music, your mind, your brain is on fire. It's hard to go to sleep. You have to come home and relax a little bit and just sit there for an hour and you don't listen to any music or do anything. Keep it quiet, maybe read. It is extremely good for your brain. The other thing, this morning when I woke up before I got on this interview, I'm now on, I think it's 1,605 days straight of Duolingo Spanish lessons. I mean, Lawrence, who I talked about, has 6 languages. Well, I only have English, and I know some Italian. And I decided to, during COVID, to start doing Spanish because in Arizona, with all the flood of people coming over the border, we have a lot of Hispanic population here in town. And I thought, well, it'd be nice to be able to speak to people if I have to. So I just started doing Spanish lessons. So my wife and I do Spanish lessons every day. And I've been doing it 1,600 plus days in a row. And that's also, you're hearing yourself, are you pronouncing it correctly? Are you putting the accent in the right place? There's a lot of brain power that's going into puzzling over that. I love landscaping. In this current house that we just remodeled, we moved in about a year ago. I did all the landscape architecture, took out 90 plants, put back in 190 plants, redesigned the irrigation system, redesigned where the lighting would be, installed 4 more lights after I was done that I thought the original design was lacking. And I have another one going in on an American flag I just put in, and it needs to be spotlit. So I've got where I'm going to be. I already bought the spot. I'll get down on my hands and knees and play around in the dirt. And that to me is just, it gets me away from trading. I love cooking. My wife and I met at dance lessons, so I dance. We did karaoke last week. So we go out and we're in a bar and we're with a bunch of friends and we get up and do karaoke. No problem. We love doing it. So there's a lot of things we do. And so when you look at my life from my view, not my 57,000 followers on X, but trading is, I don't know, if you include this even as part of my trading, which I don't, I talk about it as an interview. I'm just talking to friends. But if you take actual trading activity, that is getting data, making decisions, and sending orders, I would say that if I spend anything more than an hour a day, it would be amazing. So I have that. That's
that is
just one
mind-blowing.
hour of, I'm awake probably 16 hours plus a day. 1 hour of it is trading. The other 15 hours, I'm doing other things. I wrote a book, I'm getting interviewed, I'm, taking care of my health, I'm working out, I'm cooking dinner, whatever. There's a lot of different things I do, but they're all fun. And
Yeah.
when I try to learn how to cook, I don't just try to make a hamburger on the grill. I try to ask myself, well, maybe go to cooking class, maybe learn knife skills, maybe I don't know, explore the spice drawer and just see if I can try different meals with different things and see how it comes together. So all those things can be mentally challenging and fill your day with exciting, fun stuff. And if you just delegate yourself to 100% trading and you're in front of the screen 8, 9 hours doing nothing but staring at a computer, your health's going to suffer. Your brain's going to be pretty good with respect to trading, but it might not be hard. It might be hard to step back and see yourself as a human being that happens to trade, and instead you'll start looking at yourself as a trader who happens to also be a human being. And I think usually your marital situation suffers. Your spouse will never see you. your kids perhaps get shut out of it. You miss your son's ball game or your daughter's recital, and I think you have a very, I don't know, one-dimensional world, and it to me that wouldn't be very much fun.
I recognize myself a lot in what you are saying. I've always thought that variety is the spice of life, and I have a lot of different interests. Same as you. Sometimes, however, I recently became a father as well, and I sometimes really have a problem pulling myself away from the charts. And
Mhm.
when I'm doing something else that I as a person enjoy, but it doesn't help me with my trading performance, I kind of either my thoughts go back to the charts or I feel guilty for not working on my trading. How do you overcome that, or has that never been a problem for you?
It's a lot of scheduling, a lot of it, and it's also my wife, bless her, is very familiar with my requirements that around 1 o'clock to 2:30 or so in the afternoon, my time here, that's an area where I try to do a lot of my trading stuff. And doesn't have to be exactly at one. Like today, we're going to a stretch session where they're going to stretch all our muscles, which makes you feel really good, especially after a workout. And then we'll go to lunch after. And I won't get back at 1. I'll probably be back at around 2, but I'll crank out my orders from 2 to 2:30 or something. And I have nothing else scheduled all afternoon. So if there's a little bit of a problem, I can go to 3 or 4. Markets are closed at that point for the most part. There's a few markets that start opening again in foreign currencies and bonds and things, but it won't really affect too much that I do. And so that'll be the schedule for today. But in a perfect world, I try to not schedule anything at 1 o'clock to say 2:30. So if we were going to do this interview, then I would try to see if you guys could push it either before or after. And 9 o'clock in the morning is perfect for me because I've gotten all my overnight checkouts done and I've had breakfast done and I got my Spanish lesson done. And so I've got about 3 hours now that I have nothing particular. Like as soon as I get off with you, I'll probably work with Grok on a little bit of coding that I'm doing that I am intrigued by to see what Grok can handle, the AI version of X.com. And that'll be the next for the rest of the morning, and then I'll do my stretch, and then I'll do my market stuff, and then I'll go work out probably, and then I'll go to choir practice after dinner.
Cool.
The life of a trader.
Scheduling. Okay, I have to get better at
Scheduling.
scheduling.
It's scheduling. And with kids, it's tough, although sometimes kids will have nap periods where you can sort of rely that, every day at 3 o'clock or whatever, they're going to go to sleep for an hour, hopefully. And and the same thing's true at night. Even then, you'll have a tendency for the child to wake up in the middle of the night and want to be fed or get the diapers changed or whatever. And you can not necessarily plan precisely, but you can keep it flexible and say, okay, when the nap occurs, I've got these following things, 1, 2, 3, that I'm going to race through and get done so that I'm available to go back to the being a father. So it's a lot of scheduling, but I really, really work the heck out of my things to do list, which is on my computer, sync to my phone, sync to my iPad. I've got an Apple Watch that sync to. Uh, my schedule, the markets are pretty unmerciful with schedule. I mean, every day at 6:30 Phoenix time, the New York Stock Exchange has the bell ringing. And every day at 1 o'clock, it closes down. And it does it every day. And it doesn't care whether Tom is having a bad day or is sick or the internet's down or the electricity's off or the computer's broken or anything else. It's going to keep doing what it does. So your whole life ends up, my whole life, from time I was in my 20s, has been revolved around the timing of things. And so I get pretty good use of things to do lists and calendars. And I sought out and was able to find a calendar where my wife and I both are on the same calendar. And we just put a T for Tom or a B for Brenda. And so we both know where the other person is at any point in time. and where we're going to have conflicts and who's got to cook dinner or who's got to make lunch, or are we eating on our own? She's going to eat with a girlfriend. I'm going to fix something here and go back to the desk. You have to be able to take your life and figure out what are the essentials in your day and then schedule everything else around it. But you'll find if you just try to organize it and get used to doing it, the discipline of doing it, it's not that difficult. If you need a half an hour to do your orders, then your half an hour has got to be right around in here someplace. And that becomes a way to lock that in on your day. And if the child needs support, that might take a priority, but then right after, that's your next priority. Or you have somebody else to help you out with the child while you do what's essential, and then you come and relieve that person after. But you got to figure it out, and it's all scheduling.
Mm-hmm.
I want to be mindful of your time, and I really enjoy this, but I have a final question I'm really interested to ask. If you were starting today again from scratch in trading, let's say $25,000, $50,000 account, how would you approach trading, and what would you do?
Well, with what I know now, I wouldn't have known this back then, but with what I know now, I would probably lean towards the futures markets because it's the easiest way I can think of to get what I call true diversification. And true diversification to me is taking any one thing that you trade and asking yourself the very worthwhile question of, does the item A have anything to do with item B? So for example, if I take, say, I don't know, Tesla stock and NVIDIA stock, there's two different companies, two different tickers and all that. But if the NASDAQ is down 4% today, what's the tendency for those two stocks? They're going to both be down. It's a question of which one's down worse, probably. Very rare to see the stock market and the NASDAQ going down 4 or 5% and NVIDIA making new highs or Tesla making new highs. It could happen, but most of the time the correlations will be there. And so those two are not a diversified portfolio. If I look at what I'm trading with like 35 different things or so, and I just look at the screen, let's see, we've got aluminum, Australian dollars, cocoa, crude oil, cotton, euro, Standard & Poor's. What in that list do you think was correlated with anything else? Does crude oil really care what cocoa's doing? Does the cotton market worry about what aluminum's doing? They can, they can go their own direction, have their own economic forces, have their own breakouts, their traders jumping on, jumping out, whatever. And they're not going to have anything to do with each other. And you can go long and short with equal ease. And at least in the US, we get an advantage in the tax treatment for futures trading over trading stocks. So there's that advantage as well for people that pay some more taxes. So my attitude would be is take the 25 to 50,000, find probably around 10 markets or so that would expose you to different key economic areas. So I'd pick probably at least one stock index, like an S&P or a NASDAQ. I'd probably pick one, like an ultra bond, treasury bond, probably pick a smattering of softs, so things that are small, like lumber is a good one. OJ is not too bad. Micro copper might be okay. Sugar is not bad. Maybe a grain, so maybe something like a corn or a soybeans, wheat, something like that. And then I'd probably throw in at least one currency, so something like a euro or a Japanese yen are the two major ones. Probably euro would be my pick. And you'd have, quickly get up to around 10 contracts, and I'd trade them in two directions. So I'd go long or short with every one of them. I'd very carefully set my risk exposure. I wrote a book called Successful traders size their positions, why and how. And it's about 80 pages maybe. And it's high school math. I mean, or not even, seventh, eighth grade in the United States. It's add, subtract, multiply, divide, and hopefully you can do fractions. If you can do that, you can read my book and copy the formulas. I've been using those formulas for 40 years now. They're time tested. They keep your return to risk ratio in better shape than just allocating one contract each to 10 different markets and not being balanced, or buying 100 shares of 10 different stocks. And the dollar amounts vary and the volatilities vary, and you really don't have a truly diversified portfolio. So get that book. I think it's you can get a PDF off the website that I mentioned, enjoytheride.world. I send you a PDF for, I think it's $10 I sold it for. I am not getting wealthy off that book. And everybody in the world could use those concepts and it wouldn't affect anybody. It would still be just making your own trading a little bit more return to risk ratio oriented, and I think do a good job of managing risk and volatility. If you take that math and you take 10 markets, you put it in a 25 to $50,000 portfolio, and you limit your risk as a percent of equity and your volatility as a percent of equity to reasonable levels, something maybe 0.5% of your equity or less. I use 0.35 for mine. I'm a retired guy. I don't need to make 100% return. So admittedly, some younger person starting out with 25 to 50, even if it was me, I'd probably be shooting for at least 0.5, maybe 0.6, 0.7, try to push it a little bit. But don't go over one. You start getting over 1% to your equity, to your stop losses, you're going to have a wild ride, and you're just going to stress yourself out a lot. Certainly are not going to be Mr. Serenity. And, you might hit it lucky. And there's been a lot of traders that have done really well at those levels. They have a little bit more erratic track record, but in the end, they do all right if they can have the fortitude to stick it out. But you can set that anywhere you want. If you want it boring, you make it lower. If you want it exciting, you make it higher. But the math is right there in that book for $10, and you can literally figure out exactly where you should be. And I think you should pick your own number. You get to, as a trader, every trader out there gets to kind of pick his poison. And I'm running 0.35. That's comfortable to me. I've changed that over time lower as markets have gotten more volatile, because I think that seems to be a good comfort level for me. But I could just as easily change it back to 0.5 if I want to. It's my account. I have the right to do whatever I want. So it gives you a method and to the madness. And I think that way you'd get the maximum amount of diversification for the minimum amount of money and control it with your position sizing on the risk side. That'd probably be the advice to new traders. And I'd say the other thing, journal. You guys mentioned journaling. Journal what you're doing and try to understand yourself, your own brain, your own emotional swings. Try to increase your awareness of what's going through your head as you're doing all this. If you're tempted, as we were talking way back about traders taking their profits early, why is that? What went through your head to cause you to take that profit early? Was it a greedy thought? Was it a thought of, ooh, I can lock in a 50% return on this, and I can take my wife out for a steak dinner tonight to celebrate? There's traders that will do that. But if you're aware of the fact that you just, wait a second, that's not my trading strategy. Why am I doing that? I'm greedy. I am looking for the cheap thrill of going out to dinner. What's that got to do with my trading strategy? And that gives you the awareness, gives you the ability to know that you're going off the rails and put yourself back on the track. And then discipline becomes easy. Without awareness, discipline's very difficult because you don't even know you're going off the track. So if you can figure out a way to increase your awareness, there's books on it. Mindfulness is another term for it. Try to work on mindfulness and awareness as a young trader. so that you understand yourself better. And that will feed into succession trading. And you can do some of that with journaling and analyzing. Is there a mistake that you keep making over and over again? You know, is there a repetitive thing? The last 5 times I made this mistake, I did the same stupid thing. Why am I doing this? And then kind of think it through, figure out a solution. And but to not even think about it, you're just going to repeat the same mistake the rest of your life. That doesn't help. So that'd
That's
be my
wonderful advice. Yeah. Thank you so much. I really enjoyed this talk. There's so much more written down here that I would like to ask you, maybe around two one day, who knows. But I want to thank you for your time today. It was really a pleasure. And it was very fascinating talking to you.
It was great. I'd love to do it again sometime. You guys were fun.
Thank you. And all of the links will be mentioned in the video, in comments. You can't miss them. They will be everywhere. So yeah, thank you again.
Oh, no
Thank you.
worries.